Hey folks, Dan Frio here with your mortgage update for October 6th, 2023. So here's where rates basically ended yesterday, but they're going to be quite a bit higher today based on what? Well, based on this number right through here. The stock market is falling and Treasury yields are climbing because of a robust and strong jobs report. So what everybody was hoping for, especially the Fed, is they were saying, okay, we really need the jobs market to crash. We need people to lose jobs and people not to be working because why? What's their thought behind all this is, well, if you're not working, you don't have the money to go out and buy a lot of stuff. So that's going to drive down prices. And then if prices come down and you don't buy as much stuff, manufacturers are going to have to produce less stuff. And it's just a spiral effect for you guys out there to lose your job. So that's the thinking of the Fed. So, and that's what the other markets are focusing on. But what I want to show you guys today is let's take a deep dive into some of the numbers that we saw today that's causing this huge reaction in the markets. So we go over to our economic calendar, and for today we have average hourly earnings for you and me, non-farm payrolls, and the unemployment rate. So the number that came in robust, that's headline numbers that you're going to see on TV and YouTube all over the place, is the non-farm payrolls. You see the last reading came in at 227,000 right over in here, and it was expected to drop all the way down to 170,000, meaning people getting jobs. Well, they actually doubled that. So 336,000 people got new jobs during this time duration. Okay, but the weird thing is that many people got jobs, but look at here, the unemployment rate stayed where it is. So previously it was 3.8. They were expecting it to go down to 3.7, and it continued to stay at 3.8. So let's really take a deep dive into these numbers. So let's get a feel for what the markets are looking at and why they're in shock and all. But let me first start with this caveat. If you're in the situation where the prices of everything are going up and up and up, and you're running out of money, what are you going to do? And especially student loan payments have just started. What are you going to do? Well, you got to get out there and get a job. Okay. And there's tons of stimulus money still out there that's being used in the systems. So a lot of times when I see the jobs report, I'm like, okay, I'm not that concerned about it, but the markets are, unfortunately. So let's really take a deep dive into these three elements. So the first thing we want to look at is average hourly earnings. So to do that, we go over to this chart, and I'll put this economic chart down below. If you want to find this is tradingeconomics.com, and you can find all this information there. Here's where we were last year. Okay, where hourly earnings were at 4.9% year over year. So basically you have to get 5% increase in your hourly earnings to keep up with inflation. Where are we right now? 4.2. So a nice haircut off of hourly earnings. That's one of the things that the Federal Reserve's watching. The next thing is non-farm payrolls. Let's look at non-farm payrolls. Now here's a chart going back, I think it was 10 or 15 years ago, 10 years ago. Here's where the chart is. It goes along and it goes along and goes along, and then poof, what happened here? Well, COVID. Basically, everybody took off, everybody got off a payroll, and then they came back in a tangent. Look at how it dropped, and then it just spiked all the way back up. And we went beyond where we were previously. And then the jobs numbers start teetering back down to where we averaged over the last 25 years. So again, the job numbers, if you really take a deep dive in here, how much higher are they than we were pre-pandemic? So there's not a lot of juice on this one. And then the next thing is the unemployment rate. Let's look finally at the unemployment rate. Here's where it is. Here's where it was. Okay, the unemployment rate was, you just go back a year ago, 3.7. Went down to 3.6 and so forth, and the Federal Reserve is coming in saying we need this higher. Well, it's going higher. It went from 3.7 just a couple months ago to 3.5, and now we're back to 3.8. So we're higher than where we were a year ago on the unemployment rate. So when you look at the unemployment numbers, it's like, okay, it's not as robust as it seems. Well, let's take a more deeper dive into this. How many people have student loan debt? Well, there's a $1.7 trillion in student loan debt that people are now starting to have to pay. So there's different numbers out there, how much money this is going to take out of our system. I did an analysis, and I came up with it was going to take about $6 billion a month. $6 billion a month out of our economy when it goes to goods and services, and now it's going to be allocated to student loan debt. Okay, so that's a lot of money coming out of the system. All right. And then the next thing we want to show you is, here's what I keep saying is, guys, here's what created inflation. And here's why I'm not so worried about a lot of other people, because it will eventually come down. What you're seeing on your screen right now is consumer disposable income. How much disposable income you and I had over the last 20 years. Well, here it is. You can see right through here, the chart from the left to the right from 2000, I think 14, all the way up to the pandemic. It was a nice little flat trajectory. It increased a little bit as people saved, for a rainy day in retirement. Then all of a sudden in 2020, what happened? It spiked, and it spiked huge. 2020, 2021. So what you have to understand is the dynamics behind that. But look where we are now. If you actually took this line out and you extrapolated it out throughout the years, we'd be basically right in line to where we expect things to be. But what I want to show you guys is how much money is coming out of the system right now. Past 5 years, here's what this chart looks like. People, again, they were saving money throughout this time frame. Okay, and then boom, here's what happened. They got tons of stimulus money, didn't have to pay their student loan debts. Many people didn't even have to pay their mortgage payments for 2 years. So they saved all that money. And with that money, did they save? Well, they saved it and then they spent it on goods and services. And then they got more stimulus money, brought it up to here. And then what did they do? They started spending it on goods and services and everything else. And it depleted that money. If you go down to the where we've been over the last year, here's where we are. People have flatlined. They're now using credit, but their incomes and their assets in the bank are starting to deplete. And all this data, you're saying, okay, people have to go back to work because there's billions of dollars in student loan debt. People are running out of money. Credit card debt is at all-time high. Federal Reserve, please get a grip on this stuff. Okay, people are going back to work. They're forcing them. You're forcing them back to work. So please disregard the jobs numbers because people are basically in survival mode right now. Okay, so that's basically what's going on in the background. But if you're out there and you have a steady job and you're seeing the pinch of inflation, especially in shelter, but there's still a lot of people that are like, okay, Dan, my rents keep going up and up and up. So without further ado, let's get over to what this is doing, basically the bond markets and where I expect mortgage rates to be for today. So right here, you're seeing basically a bloodbath in the bond markets. What we focus in on for mortgage rates is right above me, right through here. This is what's going on with the bond market, and especially the mortgage-backed security bond. Why do we follow that bond? Well, it's a mortgage bond. It gives me a beat on what's going on with mortgage rates. Right where you're seeing up at the top, that is the price of a mortgage-backed security. All I need you to know is this is the price change. When the price of a bond goes down, there's an inverse relationship with that and the yield. So the price goes down and yields go up. Let me explain it to you in its simplest form. Okay, so I do this usually once a month to educate those on how this bond market really works. So what happens is, here's the price of the bond. Okay, so let's say, for example, the price of the bond is 95. Okay, so I pay you 95 today. And next year when I turn in my bond, my coupon, so what I do is I give you $95, you then give me, well, let's make this simple. I give you $50 today. This is going to make my example a little more easy or palatable. I give you $50 today, and that bond matures that I'm buying from you next year, and you're going to give me $100 back. Okay, so if I give you a low price, I give you $50 on that bond, you give me $100 back. Well, how much is the difference there? How much gain did I have? Okay, I remember I give you 50, you're giving me $100 back. I doubled my money. My yield is 100%. Fantastic yield. Okay, so let's turn this around. Let's say the prices go up. So let's in turn say I give you $100 today. Next year, you give me my $100 back. And you're like, Dan, why would you do that? There's nothing. There's no return. Exactly. I give you $50, you give me $100 back. It's a low price. I'm doubling my returns 100%. Now I up that price to 100. I give you 100, you give me $100 back. I got a zero return, zero yield. You see how when the price goes up, the yields come down. So that's how the bond market really works. So with the economic news we have today, here's what we're seeing for mortgage rates. You're going to see this probably go up to the 7.75 or the 7.72 that we teetered at just a couple weeks ago. You see on the 52-week high over there. So what you're seeing at the bottom is the 52-week low and high. The low was 5.69, I think it was, and then the high is 7.72. We're probably going to be teetering on that later today. Guys, this is going to be temporary. And what I mean by temporary, it's not going to last forever. Okay, even the bond analysts are telling us there's a huge spread in this bond market right now. There's a lot of risk premium built in, and that's what's pushing up rates to these astronomical yields. But it will curtail. We have programs out there to assist you guys to help you buy down interest rates, have the seller of the property participate in some of those buy downs on rates, because right now you guys ask for it. You're like, the FOMO in buying houses is nuts. We need that to come out of the system. So if we're looking to buy a house, we can actually go in a house and we don't have to bid with 100 other bidders to make that or push up those prices on homes to astronomical levels. What you're seeing in the housing market right now is stability. Most markets basically are just flatlined when it comes to prices. So by pushing off your purchases, especially last year and the year before, you have the same prices in most areas. There are pockets of the country that are down, 5 or 10%, but the majority of the country is basically at 0 to a 5% increase in home values. So again, what I'm trying to explain to you guys is this is a temporary situation. We see the ups and downs with mortgage rates. A lot of you guys haven't really realized this over the last 5 or 6 years because we've been in pandemic mode, and the federal government and the Federal Reserve has been basically driving down interest rates to spur the economy. Now they've spurred it. They've basically flatlined the activity on housing. So maybe a good time for you guys to go out there and bid on a house because you don't have much competition. So if you're out there looking for, you're like, hey, what do I qualify for? Can I even qualify with today's rates? Can I qualify with my income? Do I have enough money for the down payment? Well, don't disqualify yourself. What I ask you to do is reach out to us. I'm a mortgage advisor, have been doing this for over 33 years, and I'm licensed in all 50 states as well as Puerto Rico. I would love to help you. How do you reach out to us? Well, few ways. Up there's an apply now link. What you're going to do is you're going to click that. It's going to vet you basically. It's going to ask you a few questions just to see where you're at, what kind of loan products you're looking at and so forth. And then from there, it's going to route you to the advisor on my team that specializes in exactly what you're looking for. So that's number one. But if you're out there and you're like, Dan, can we just call in? I'd love to talk to you or one of the guys on your team. Or, can I reach out to you directly via email? Absolutely. Here it is right here. You can give us a call at 844-775-5626, or you can email me directly, and yes, it is me directly, at dan@therateupdate.com. God bless, guys. I hope you find value in my channel and hope this makes it a little more understandable at how to basically analyze real estate and what's going on in the markets. And when a lot of people tell you on TV, what's going on, maybe you can get a little educated so you can really know the deep dive in a lot of these subjects. So thank you so much for watching. God bless. Have a fantastic weekend. See you next week. Bye-bye.